What up, everybody? Marc Blair back at it again. Money Coach MB with Own Real Estate. Marc Blair just wanted to recap and bring back to you guys episode number 2. Not really episode number 2, but I just wanted to come back a second time just to tell you guys a little bit more about the taxes that we have to pay. Last week I did one just breaking down the federal versus the state and the sales tax, just what Uncle Sam is taking and why 52% of our money is going to Uncle Sam and the other 48 is actually going in our pocket, not including the rent or the mortgage and all the payments that you have to make, right? But what I wanted to talk to you guys about today was something else that we really don't pay attention to as well, and they don't share. Right here, right now, I have what's called a W-4 form. If you can see this form well, this form is the form that we receive when we get employed or get hired for an employment opportunity for a job. They give us this W-4 form and they tell us to complete it with the number of allowances that you are able to claim or they tell you to claim. But here's the secret sauce that is the problem because of the lack of knowledge or education that they're sharing with us, is that when they give us this form, it typically comes in a soft copy via email. They never really give you a hard copy. But when they give you this form right here, they only give you what? The first page. Okay? They only give you the first page, and they only tell you to do what? Choose a 0 or 1. Those are really the issues that you have here. So 9 times out of 10, we're going to fill out a 0 or 1, right? Regardless of the situation. And when you ask a person why, they don't tell you what? They tell you what? I don't know, just because somebody else did it or that's what they said to do. And you don't understand what that really means and how much money, aka opportunity cost, that is costing you for this. But I'm gonna explain this a little bit further after I go through the examples that I'm gonna share with you today, and I'm gonna share with you the other thing. So that's the W-4 form. And then we also have this right here, this form here, which is called the Schedule C form, which deals with from a Form 1040, which deals with profit and loss from a business, right? These are for business owners. Business owners fill this out to maximize on their deductions. Remember last week I told you that I was going to show you how to maximize on your deductions? Well, I'm going to show you that right now. So the 1099, the sole proprietorship and the Schedule C form is what we use when we are filling out our deductions. So I just wanted to tell you about that. So when we talk about the two people, W-2 person versus a 1099 person, there's two separate people. W-2 people are people who are just employed working a job. 1099 people are business owners. So when I explain to you guys what it's really about and how you're going to maximize on your deductions, you need to first have a business. And I'm going to share with you why. Watch this. So you have two types of people, right? You got W-2 people who are essentially employees, right? And then you have a 1099 person, right? Call them business owners. Business owners, and that's a Schedule C. Call them Schedule Cs. Okay? And remember, my disclosure right now is I am not an accountant. I'm not a CPA. I didn't go to school for it. Again, I got this information. I understood. I learned how the information was being conveyed, how to capitalize and maximize and increase my financial IQ to be able to make smarter decisions for when it comes to saving money and being able to reduce your tax liability for business owners, which is why the wealthy people continue to become wealthy. Okay? But you have the two types of people, W-2 person and a 1099 person. And let me give it to you real quick, because again, I don't want to go too long with this, because it's not a teaching class. I just want to be real quick. When you're a W-2 person, right, you really don't have no tax deductions. All you have is your simple day-to-day lifestyle, and whatever you decide or choose to do is what you do. 1099 person, they are people who can maximize on certain things that they do and be able to adjust their income with what they call write-offs, okay? So, remember last week I used the example of $50,000 for a person coming out of school. Let's use that same number of a person making $50,000 a year. Let's just say these two people, and I actually had a conversation with a client yesterday, and I explained to her when she was looking to buy a house. I was explaining to her what the adjustments mean by if she did own a business, and show her why, so she can do some things in regards to home ownership. So if you're making $50K a year, a W-2 person and a 1099 person, as a W-2, let's just say both of these people came out making $50,000 with the same income, same job, same location. They live, they pay the same amount of rent, they pay the same amount of car note, they pay the same everything from top to bottom, okay? Let's just say they both bought a house. They both got a nice townhouse, the same amount, paying the same amount in mortgage, okay? Let's just say this person right here, again, we do know that the interest on your mortgage is a tax deduction. And of course, after last year, it goes into standard deductions depending on, you know, your AGI, which is your adjusted gross income, but that's for another day, right? But for now, for simplicity, I'm going to let you know that they both have a home, a townhome or whatever, or a townhouse, single family, whatever it is. They're paying a mortgage. Let's just say the mortgage is, $1,000 a month, okay? And we all know that the interest is a write-off. Right? So that's a write-off for both parties, whether you're a W-2 or a 1099. So the write-off, not including the interest, both of them have an interest deduction, but the write-offs on top of that $1,000 mortgage is not a write-off, right? So the write-off, if they have a mortgage and they pay their mortgage, they have no write-off. If a 1099 person, right? This person who works the same job, let's just say they're engineers or, they're accountants or whatever you are, but they have a business, right? In addition to their job, they have a home-based business or whatever that may be. If the mortgage is $1,000 a month, and let's just say the business that they have is a barber shop, right? I have a bar, I cut hair in the evening times in my basement, right? And if the basement is let's just say the basement is essentially 25% square footage of the entire home, right? So if 25% is the basement portion of the entire home, of that $1,000 that they're paying in their mortgage, 25% of that is now going to be a tax deduction, right? So that's $250. $250 times 12, you get what? $3,000. Right? So now you have a deduction of $3,000 for this person who now has a mortgage. Okay? The mortgage for this person. All right, now let's just say they have a car note as well. There's no write-off for the car. The person who has a regular job, when they're going to job and go to lunch, to travel to and from work, there's no write-off. If they stop to go get gas and they have a business card that they're going to pass out to let a gentleman know that they have a grooming service in their basement or whatever the situation is, they're now marketing. So the mileage on that, traveling to and from the house or to and from the job, is now going to become a tax deduction because you now what? Legally, morally, and ethically attempted to conduct business, which now the IRS or Uncle Sam is looking at it like, you're trying to increase the economy. So now for that reason, you're going to get a write-off. So in this case right here, they give you, Uncle Sam gives you 50, I believe it's about 58 cents a mile. Again, you could double check all that, but 58 cents a mile. If you did 10,000 miles on the year for business, right, 58 cents a mile, you're at $5,800 of write-offs, right? It works the same way. Meals, you're gonna eat, you got no write-offs because you have no business. Over here on the meal section, if you went ahead and conducted business during your meals, and you spent $3,000 a year in food, you now get to write $3,000 off, right? Same thing. What else we got? We got, travel, right? If you're going to travel, right, there's no write-offs. You take trips all the time. But again, if you don't have a write-off or you don't have a business, you can't write nothing off. So now you're taking trips with your girls and your dudes. Y'all going to have a good time, but you're going to have a good time spending money, and you're not going to get it back. Over here, I'm like, you know what, let me go out there. But as I'm going out there, I'm going to try to see if I could build a client, up there. If I go cut a hair and do some business while I'm out there on a trip, right now I get to write that off. So now my trip that I spent $2,200 or $2,000, right, is now become a tax deduction, right? So you have that. And then here's ready for the last one. You got the child labor law, right? The child labor law from the ages 7 to 17. you got a child labor law. That's where Uncle Sam actually pays you, or the child actually pays you as the business owner to pay the child to be able to increase their capital, their awareness to their companies. Now, how does that work? Ages 7 to 17, that's no different than your child going to work for Best Buy or Target or Chick-fil-A or whatever the situation is. They now get write-offs as an allowance to be able to pay those employees, right? The child labor law over here, as a W-2, there's no allowances you give your child. What allowance you do give your child, you have it as 0, right? You do not get any type of deductions on the child labor law. Over here, in this case right here, on the child labor law, they give you, Uncle Sam gives you $4,500 per child, right, as an allowance. So the child that, if they're sweeping up the floor in the basement, to if you're hosting a party for for your hair salon, they clean up the hair after they finish, or you have to go get some refreshments or appetizers or snacks for people to come get, or whatever the situation is. You're now employing them because you're going to give them allowance anyway. You might as well make it a write-off. So at that point, if you have 2 kids that you're doing a labor law or allowance to, 4,500 times 2, you had $9,000. Right? That's just real quick. I just wanted to share with you a W-2 person who will have what? 0 write-offs. The 1099 business owner, Schedule C person, will have these write-offs, right? So now when you look at the numbers, it's what? You had 9, 13, 2, 3, 5. You had 20, what's that? 22, 8 or 23, 8? Right? 800, right? Or $800. So now over here, you actually have a write-off of $23,000, right? Over here, you have a write-off of nothing. So over here, you spent $23,000. Over here, you had to deduct $23,000. So the same people making $50,000 a year on their job, doing the same exact thing from start to finish. One person was to deduct $23,000 for having a business. The other one get to spend $23,000. You do the math. You choose where you need to be. I just wanted to bring this to light, let you guys know how it works. And then now, on the next episode, I'm going to bring it to you and let you know exactly how and what we do with this money that you have a deduction from, and how to be able to capitalize and get some more money while you still do what you need to do on a regular basis. Again, Marc Blair signing out, Money Coach MB. Follow us on Instagram at Own Real Estate Global, as well as me at Money Coach MB. And I will talk to you next week. Stay warm because it is cold out there. All right, peace.